started. Last week we didn't quite end chapter 9 because we didn't get to the adoption credit. But most of chapter 9 was about the child tax credit, the additional child tax credit, and the dependent, other dependent credit. Then we also talked about the child and dependent care credit. We'll finish off this chapter with the adoption credit, and then we'll go ahead and review chapter 9, and then we'll go through the classwork, and then we'll start, we'll go backwards and we'll start chapter 8. So any questions before I begin? Okay, great. So the adoption credit is the final credit in this chapter, and this is a credit of up to, well, this number goes up each year for inflation, but in 2022 it was up to $14,890 for qualifying expenses you had to adopt an eligible child. As we'll see in just a moment, this is a very important number because if you adopt someone who is considered a special needs child, you get the full amount of the credit regardless of whatever expenses you had. So that's a pretty big dollar credit and fairly generous one.
So if they're a standard child, not special needs, then it's whatever your actual expenses are?
Yeah.
Up to that amount?
Yeah. So in fact, we hardly ever see a regular adoption that's not a special needs child, so we don't usually worry about qualifying expenses. A child with special needs is not what you might think of as special needs in like an educational setting. Special needs just means that the child cannot remain with their parents for health or for good reasons, and it's unlikely that the child would have been adopted without some sort of assistance from the state, which is almost all of the adoptions that we see for our clients. These are people like adopting their niece or nephew because the children's parents are dead or incarcerated or incapable of being parents. People adopting their grandchildren, these are fairly common. Or we'll also see foster parents eventually adopt their foster children, and it's usually because the parents are unsuitable to have the children placed back with them. Okay, so first of all, so we won't talk too much about what the actual expenses are or the timing of when to take the expenses, because so far every single adoption credit that we've taken in this office is for a special needs child. We've taken the entire amount of the credit. So first of all, an eligible child is any child under the age of 18 at the time of adoption, or it could be someone who is physically or mentally incapable of caring for himself or herself. So far, all the adoptions that we've seen are for children under 18. Okay, so the full amount of the credit, $14,890, is allowed for a special needs child if all of the following are true. The child must be a U.S. citizen or resident. A state determines that the child cannot or should not be returned to their parents' home, and the state determines that the child probably would not be adopted without assistance from the state. So usually that means that the state is providing some sort of payments for the care of the child, like foster care assistance payments or Medicare waiver payments. And second, so that right there is probably enough, right? And the state is actually paying all of the expenses for attorneys and stuff like that. So to get this full credit, all we need is everyone's going to have a contract with the state saying, like, we're going to provide you like $600 a month in child rearing assistance or foster care assistance until the adoption, and we'll pay for all the adoption expenses. And almost always in the contract, it's usually close to the bottom of the first page in the contract or the top of the second page, or it's not really, it's called an agreement or contract. It'll specifically have those words, special needs. So it'll say, because of the special needs of Joe Johnson, we're going to provide you assistance for taking care of and adopting a child. So we won't worry too much about adoption expenses, employer-provided expenses, because so far I haven't seen that at all. And we will talk about some of the limitations. In order to take the adoption credit, you must, if you're married, you must file a joint return, unless you qualify for head of household, which is what these exclusions are, or exceptions. So you cannot claim this credit if you're married filing separately. So if you're going to file, if you're married, you're adopting a child, you should file a joint return to claim this credit. It's $14,890, and that is a non-refundable credit, which means that it can reduce your tax, but not below zero. Let's see. And that reduction, let's see, so that means a lot of the time your adoption credit will be unused, part of it, and you're allowed to carry over the excess up to 5 years. So if you adopt a child in 2023, then you can take this credit in 2023, and anything that's left over you can carry over to 4, 5, 6, 7, all the way up to 2028.
So how long can it be rolled over for if needed?
For 5 total years after the adoption. There are also some adjusted gross income limits. So if your adjusted gross income is over 223,410, or is under 223,410, then you get the full amount of the credit. If your income is over 263,410, you get none of the credit. And if you're in between those numbers, you get a partial credit. So to claim this credit, you have to use Form 8839. There's an example of that on page 293. And you have to have the child's name, year of birth, and identifying number, in other words, their social security number. It could be, in some cases, an adoption taxpayer identification number or individual taxpayer identification number. And then this is how we would fill it out if it were a special needs child. We would check this box under column D for special needs, and then we wouldn't even talk about what the actual expenses were. We would just put the full amount on line 5 if there was a child with special needs. In this particular example, the child was not special needs. And again, we hardly ever see like those traditional, where you go to a fertility clinic or whatever and you adopt a child. It's just almost always special needs children, people adopting foster children that they've been raising, or other relatives that, their brother or sister's kids or their grandkids, things like that.
But you can adopt children through fertility clinics?
Well, I don't know. Okay, so here's where we see that it's a non-refundable credit that can be carried forward up to 5 years. Let's see. And then there are special timing rules if you actually have to claim qualifying expenses. But again, we're not going to worry about these timing rules because all of our adoptions that we've done in this office so far have been special needs children.
So the timeline is more specific, it's not special needs?
If it's not special needs, then you actually claim this credit for a domestic, a US citizen for domestic adoption, you claim it in the year the adoption is final, or the year after the year you pay if the adoption is not yet final. And for a foreign child, it's always going to be, you have to wait until adoption is final to take any credit. So if it takes you like 2 or 3 years to adopt a child, and you spend $4,000 to adopt, pay $4,000 to an adoption agency in 2023, and your adoption isn't final until 2025, you can take this credit in 2024. So some weird timing rules there. But in case of special needs children, you just take the whole $15,000 in the year the adoption is final. So let me do a quick example for, this is fairly similar, fairly straightforward. So let's say we have a married filing joint couple, and their income, let's see, their only dependent who was adopted (2022) and with special needs. Okay, let's say their income from working was between the two of them, let's say 58,000, and let's say they got a PFD of 1,312 each, or 2,624. Okay, so their total, and they have no adjustments, so their total adjusted gross income is going to be 60,624, and then they'll take their standard deduction of, what was it, 25,900, which makes their taxable let's see, that's going to be 34,724. Okay, so if we look that up in the table, $34,724 taxable income, married filing jointly, 3,756. And then we also actually have the child tax credit and the adoption credit. And this isn't really gone over in the book, but the order of which credits you take when on your tax return is always arranged to be the most favorable to the taxpayer. So if you want to come to me after class, I'll explain why, but we'll actually see a $500 child tax credit and a $3,256 adoption credit for net tax of 0. And then we still have the additional child tax credit of $1,500.
And that's a refundable credit?
Yeah, that's the refundable child tax credit. Remember, you use up whatever is unused from your child tax credit is your starting point for the additional child tax credit.
And you want to use your non-refundable credits before refundable credits.
Right. So the child tax credit would be wasted if you didn't use it first. So that's why they let you use the 500 out of the 1,500 first, because your refundable credit can't be more than 1,500 per child. So we have this, so we had our adoption credit if it's special needs, there's a 14,890 credit. And then 3,256. This part is used in 2022. And so next year, they're going to have whatever's left over. And they're going to be able to claim on their 2023 tax return 11,646 credit, but again, limited to their tax. So they will eventually, as long as their tax situation is the same from year to year, they will eventually use up this adoption credit, because you have up to 6 years total, the original year plus 5 more years to claim this. So this $3,000 per year is going to eventually use up their adoption credit. But we've seen people whose W-2 income is much lower, and there's actually no hope of them ever getting the full benefit of the adoption credit. Which is one thing that we can, if we can figure out some way to generate taxable income, such as by an IRA to Roth conversion, then if we create taxable income, we create a tax liability that then can absorb the adoption credit. So there's some creativity involved in helping people plan their taxes. But this is basically how the adoption credit would wash out for this person. Without the adoption credit, we would assume that maybe they probably had about 4,000 withheld. Well, technically that would go on a line above here. So they would have like a $5,500 refund. And this is another thing that that you need to be able to explain to your clients, because these people might have heard about this $15,000 credit, and they may ask, well, why aren't we getting a $15,000 refund? Plus, $2,000 child tax credit, we should have a $17,000 refund. But you need to be able to help them understand that the adoption credit can't be used past, bringing your tax bill for the year to 0. So you're going to get, this particular couple will get the full adoption credit, but it will take a while for them to get it.
So the additional child tax credit, because the kid that they adopted, that's a value of 2,000. They're only able to use 500. And basically you're maxing out their additional tax credit, and so you use 500 of it before in 1,500 as a refund.
Yeah, because the additional child tax credit is limited to $1,500 per child. So because of that, we want to maximize this part, so we minimize this part and go down to 500. Because this part can never become a refundable credit, that extra 500.
Okay.
That's the difference between their full child tax credit and the full amount of additional child tax credit that they could conceivably claim.
So it's not that, so the whole thing is not refundable. That 500, it just has to be, it's just a matter of, if they had 2 kids, then, you'd be trying to use, for example, 2,500 worth of credit,
Well,
right?
this is, so here are non-refundable credits. And here is refundable. So remember, non-refundable credits are subtracted from your tax, but refundable credits are added to your payments. So if they had 2 kids, so let's say they had one dependent who's adopted in 2022, and one other dependent under 17, so they also qualify for the child tax credit. we would, remember it's up to 1,500 per child. So the refundable part of the child tax credit can't ever go to more than 3,000 if they have two. Which means we would we would want to maximize the refundable part, which means we have 1,000 left over that can't be refundable. But remember, this tax can't ever go below zero, so we end up actually only putting 2756 here. And then they would still get a $7,000 refund. But they would have more to carry over to next year. So this would be 27 something. And this would be 12,100 something.
Now, the earned income credit, is that refundable or non-refundable?
The earned income credit is refundable.
So they would actually have that one in there too.
Yeah. Yeah, but with two kids, I think they're outside of the income range to claim earned income credit.
Well, you have to be on the like bottom spectrum of the income to get the earned income credit.
Yeah, the cutoff for married filing joint is adjusted gross income of 55,500 for two children. So they're just barely over that.
So you have to generally be like a single earner household and just barely average to get the earned income credit. Anybody above average probably doesn't get it, is that not right?
Yeah. Okay, so child tax credit, 1,000. And in this case, well, they just barely are going to be able to take all the child tax adoption credit. It's one thing I wanted to double check just to make sure the math works out. Times minus. Oh yeah. Based on their earned income, their additional child tax credit could be up to 8,325. Remember, we do that by taking their earned income, subtract 2,500, and multiply the result by 15%. Okay.
But these are the smallest of the two, so it's still max out at the $3,000.
Yeah, up to 1,500 per child. Okay, so that was all of chapter 9. Let me try to summarize on kind of just one page everything we learned about chapter 9. So, the child tax credit is for qualifying children who is under 17 years old at the end of the tax year. And this is 2,000 per flat, 2,000 per child. And this is non-refundable. Okay. Then the additional child tax credit is up to 1,500 per qualifying child under 17 years old. But it's also limited to the unused part of the child tax credit. And it's also limited to earned income minus $2,500 and then 15% of that result. And I didn't mention the AGI limits on any of these. It's about 400,000 or so. If you're married, or 200 and something thousand if you're single or head of household. Next, we had the other dependent credit, which is, includes qualifying children, 17 years old and up. Or any qualifying relative. And the amount of this credit is $500 each and non-refundable. And again, I'm leaving out a lot of the details. This is just a general overview. Oh, and this part is this additional child tax credit. This is refundable. Okay, so these are the main benefits that you get for listing someone on your tax return in the dependent section.
So the qualifying relative is the, or the other dependent, here you said qualifying child 17 years old and up.
Mm-hmm.
Oh, so if they've aged out, you can still get this one, or if it's a qualifying relative.
Mm-hmm.
Okay.
Yeah,
It's
remember
just
your
flat
qualifying
out.
child can be up to 23 years old if they're in school, under 24, or they can be any age if they're disabled. But a qualifying relative does not have an age limitation.
Gotcha.
Okay, and then next we have the child dependent care credit. So child and dependent care credit is anywhere from 20% to 35%, depending on your AGI. Of qualifying expenses. For a either a child under 17, and I believe it has to be a qualifying child under 17 or under 13, or a spouse or dependent who is, I'm just going to abbreviate that as incapable. And what I mean by that is physically or mentally incapable of self-care, meaning they can't wash themselves or they can't use the bathroom, they can't cook or something like that. Your expense limitation are either expenses are limited to your actual expenses, whatever you paid for care for people who are under 13 years old. And I should mention that this age limit is special. This is the only time basically in the tax law that we care what we have a change in someone's status in the middle of the year. 13, they have to be less than 13 years old at the time care is provided. Okay, so your expenses are limited to your actual expenses or earned income, and again, limited to spouses' earned income. But this is only the case if you're married filing jointly. So what this basically says is to claim this credit, both spouses have to have earned income. And it's also limited to 3,000 with one qualifying child, or qualifying person, I guess, or 6,000 with 2 or more qualifying children, or qualifying persons. And just as a reminder, you can have 2 qualifying children and have the $6,000 limit even if you're not paying for one of the children. So if you have a kid, you know, you have a 6-year-old who's in school and a 3-year-old who is being watched during the workday, and you only pay for someone to watch the 3-year-old, you can claim the full $6,000 in expenses, even though the 6-year-old has no childcare expenses.
On the child tax credit and additional tax credit, is there a point at which you stop counting kids on
No.
it? So if someone's got 10 kids, they can do 20,000 a year.
Yep.
Okay.
Yep. We have one client who had, I think the record is 13. 4 adopted and 9 natural.
Right. I just didn't know if there's at a certain point the marginal value of each additional changes, or
No.
they stop including counting.
Nope, there's no limit on the number of children you can claim.
And that goes for pretty much all of these except for the dependent care credit.
Yeah,
Now.
this is only 1 or 2 or more, so the 3rd one doesn't count.
Yeah.
And the 4th one and so on.
But the rest of them are totally linear in terms of how many kids you get, you just multiply it across.
Yeah.
Okay.
Same thing with your other dependents. If you have multiple other dependents, it's 500 each, regardless of how many. And finally, the adoption credit. Oh, this is also, I should mention, is this was non-refundable, this is non-refundable, this is non-refundable. Okay, and the final credit from Chapter 9 is the adoption credit. And we're just going to only talk about special needs children. And it is just a flat credit in that case of $14,890 in 2022. And it is non-refundable. But you can carry it over, C/O is short for carry over 5 years.
Can you carry over any of the other ones?
No. No, any of these other credits, well, this is refundable, so you always get the full benefit, but these ones that are non-refundable, if you can't use them, they're gone. And it can be kind of hard, it's actually fairly hard to explain to some of our clients what the drawback of a non-refundable credit is, because people are always thinking in terms of their refund or their balance due at the end of the year, and not what their actual tax for the whole year is. So, for example, if someone's income is less than their standard deduction, their tax is 0, because their taxable income is going to be 0, which means all of these non-refundable credits, there's literally no benefit for them. You know, the additional child tax credit might come into play, but because that's refundable. But the non-refundable credits, there's no benefit. So they might say, well, you know, I had, so we have a couple who's married and they've made $25,000 a year, and they may say, well, what about our child care expenses? Well, literally cannot benefit you because your tax is already 0. Or
because they're standard, they make them below the standard deduction.
if they make less than the standard deduction, their taxable income is zero, therefore their tax is zero. So a non-refundable credit can't help them. On the other hand, if they did have some tax, let's say they made 50,000, so their tax, after the standard deduction, their tax is gonna be about 2,500. And so they do get the benefit of this non-refundable credit, even though maybe they have 5,000 or 6,000 withholdings, they're already getting a refund. This is going to increase their refund, these non-refundable credits, but indirectly by reducing their tax for the year. So one way I have tried to explain it is it's like a store credit that you can only use at the IRS store to pay your taxes. And because it's already been paid with these non-refundable credits, you get your money back from your paycheck that you've already paid in. But you don't, but once it gets past the amount of tax that would have been due for the whole year, you won't get any more than that back. Okay, let's soak this in for a minute or two, and then we'll go on to the classwork, which will be page 296. Okay, I'll start and we'll continue around the classroom. Number 1, the child dependent care credit can be claimed for expenses paid for the entire year, even though the child's 13th birthday was in October of the current year, and that is false. You can only claim the expenses up through that child's 13th birthday.
If it was a flat monthly fee for the care, like a monthly daycare fee, would they include that full month, or would they have to try and prorate it?
You should probably prorate that last month, that October, because remember, it's at the time the care was provided, so not necessarily at the time you paid for it. So if you paid, let's say you pay $1,000 a month, you would, well, you would be way over the 3,000. So let's say you pay $100 a month, then January through September would be 9 months, you would claim that 900, and then whatever fraction of the month they have in October, you would take that part.
And you generally count their birthday as well, or that's the day you don't count for it?
That would be the day that you stop counting. So if they were born on October 13th, if that was their birthday, you would count 12 out of the 31 days in October.
Gotcha.
Okay, Dimitri, number 2.
You may qualify for the additional child tax credit, which is refundable when the child tax credit is more than your tax. True.
True. Yep, that's the whole point of additional child tax credit. All right, Daniel, number 3.
The child must be under age 17 to be a qualifying child for child tax credit. True.
Yes. Okay, Mercedes, number 4.
The child tax credit may be claimed by a taxpayer who files married filing separately. False.
That is true. That is actually could possibly be the only benefit that you can claim while still married filing separately. So the child tax credit is special in that case. Almost everything else, if married filing separately, means your credits are gone. Okay, number 5. Harry and Louise's 3 nephews are aged 12, 14, and 17, and they claim to live with them on March 20th of the current year. Harry and Louise file a joint tax return. Their taxable income is $7,960, and their tax on line 16 of Form 1040 is $798. They have no other credits. Harry and Louise can claim a child tax credit on line 19 of, well, let's see. First of all, They, let's see, age 12 qualifies, age 14 qualifies, age 17 is too old for the child tax credit. So they would get a child tax credit of up to 4,000, well, plus 500 for the other dependent credit. But the main thing is the child tax credit is non-refundable, so it's limited to the amount of their tax. So it's going to be 798. So and this note here, this should say additional child tax credit refundable. Okay. All right, Dimitri, you get the math question.
The most that they can claim is gonna be based off of their earned income.
Mm-hmm.
But it doesn't say what it mentions their taxable income, which should be post standard deduction, right?
Right.
So you could have to add that back in.
Mm-hmm.
Plus 25.
So let's just, for the sake of the exercise, let's just call it,
In this case,
33,000.
anyway.
yeah. So let's just assume that their earned income is 33,000.
Yeah, you're closer to 34, but either way, you end up with 15% would be closer to $6 grand. So either way, they'd be maxing out the 1,500 each. So
Mhm.
it'd still be B 3,000.
3,000 is, I believe that's right. So let's just double check. So their earned income is way over enough. Without even having to do much calculation. But let's just double check. Their total child tax credit and other dependent credit was 4,500. And they used 700 and how much?
798.
798 as regular, non-refundable child tax credit. So yeah, so this is going to be like 3,702, which means since this is less than that, it is 3,000. So that is correct. I don't know what that is supposed to mean. Okay. Daniel, number 7.
Fred sends his dependent child, age 8, after school daycare so he can work during the year. He paid $2,200 for the care. He received wages of $33,740 and $1,360 of taxable interest. He had no other income. What is the child and dependent care credit amount he can claim?
I'm curious, most like after school programs that are available, like, are they only available for like 3-4 hours out of the day?
I think so, yeah. From like when school gets out to like 5:30 or 6.
So do these programs go and pick up the kids
Some of
and
them
then
do.
like take them over back to like the daycare facility usually?
Some do.
Some of them do, but as far as I'm familiar with, I mean, I don't have any kids, so it could definitely be wrong. But as far as I'm familiar with, the buses will take, the school buses will take them to where they're going.
So
Yeah,
like
for
school
example-
buses one of the school buses will drive past the Boys and Girls Club and drop kids off effectively.
Yeah. When I was growing up, in like 3rd and 4th grade, I would take the school bus to my babysitter's house, who was on another side of town from my home. But as long as my parents arranged that with the office and said, when you go to school, you get on this bus, but when you come home, you get on this other bus that takes you to the babysitter. And then my mom would come pick me up after work at 5:30.
Gotcha.
None of these?
Well, let's see. So, first of all, what are his work-related expenses?
Work-related expenses?
Yeah, for the child dependent care credit. His expenses that he can claim. What is that?
$2,200.
Yep, $2,200. So this is an important number. This is what we're going to count his expenses based on, because his earned income is more than that. And it's limited to 3,000 because he has one qualifying child. So it's less than both those limitations. So we take the whole 2,200. The second thing we have to do is we can look at the chart at the bottom of page of the form 2441 on page 288. And it asks us to figure his adjusted gross income and look it up on that chart. So we have to know what his adjusted gross income is before we can answer the question. So 33,740 plus 1360 is, looks like 35,100.
So AGI is always before your deductions and such, right? That's
Yeah,
like
before
total.
your standard deduction. After adjustments, before standard or itemized.
And the most common adjustments is gonna be your retirement savings, things like that.
The most common one that we've discussed so far. Yeah. Okay, so we look up 35,100 and we look on the chart and we see that that gives us a credit percentage of 0.24. So 2,200 times 0.24 528. And just to be super careful, what we would also do is we would, we would actually do his, take his standard deduction, figure out what his tax is. But if they wanted us to do that, they would have told us what his tax is. So we can safely assume the answer is 528.
Non-refundable.
It's a non-refundable credit, right? So if his tax turns out to be less than 528, he won't get any benefit of this. Okay. All right, Mercedes.
Which of the following is a refundable credit? None of these.
Well, it's actually earned income credit, but we skipped that chapter, so that wasn't really fair.
Can we go back to question 7?
Yeah.
I was just doing the quick math. It seems as if potentially he'd only owe like $130 maybe in taxes.
Mm-hmm.
If in this scenario he had a tax credit of 528 for the child care, and then assuming he gets the child tax credit of 2,000.
Yeah. This is good practice. Let's go ahead and do his tax return. So Fred is single. Single being his marital status, I'm going to assume his filing status is head of household.
Oh yeah, I didn't count that. So
Yeah, it should be head of household because we're going to have to ask him if we're actually doing his taxes. Did your daughter live with you more than half of the year? And do you pay more than half the cost of keeping up the home? Which, another way to ask him that is like, does anybody else live with you? So if he's the only one living there with his daughter, then he pays 100% of the cost of keeping up the home, which is more than half. So Fred is going to be head of household. He has one dependent who's a qualifying child under 17, so who qualifies for the child tax credit. So if you, I'm not going to use the tax form to do the tax return, but he has wages, interest. How much was his wages?
33,740.
33,740.
An interest of 1360.
1360.
So 35,100.
So 35,100.
And obviously this doesn't account for PFDs.
Right. So adjustments, none. So that's his adjusted gross income. All right, and then what's the standard deduction gonna be?
I forget what HOH is.
19,400.
Sounds right to me. And that makes his taxable income see,
15,700.
yeah, 15,700, do you agree? Okay. So now we start page 2, so this is all page 1, and now on page 2, we have, start with his tax, based on his taxable income. So look that up in the tax table. Okay, 1,594. And then, so we didn't, the problem didn't mention what his withholding is, so I'm just gonna make a number up. And let's say withholding is $2,500. Okay. So now we have tax, and then we have these two credits. We have the child tax credit and the child and dependent care credit, but we want to count the child and dependent care credit first, because if that's not used, it's wasted, but any unused child tax credit rolls over into the additional child tax credit. So this child and dependent care credit, we've just figured that out. What was that?
528.
Mm-hmm. Okay, and then his child tax credit, which could be up to $2,000, but so far, this subtotal is just 1,066, which means we can't take more child tax credit than would be enough to reduce his tax to 0. And people who use, like accountants and people who play with dollar amounts usually put negative numbers in parentheses instead of a minus sign. So if we add that up, we should get 0 if I've done that math correctly. So this is his total tax. And now, for payments and refundable credits, we have withholding of 2,500 and additional child tax credit of how much?
934.
Exactly. And neglecting any earned income credit is not going to qualify. Just wanted to double check. Oh, he would qualify. So we're neglecting the earned income credit. We'll come back to that, and because we're coming back to that chapter. But neglecting the earned income credit, he's already got a refund of $3,434, of which $2,500 is just his own money coming back to him, but $934 is extra refundable credit coming back to him. And it helps to just become familiar with this flow. And you can do tax returns without actually filling out the forms, as long as you understand this flow. Income minus adjustments is adjusted gross income. Adjusted gross income minus your standard deduction is your taxable income. Taxable income results in a tax amount. Tax minus refundable credits is your total tax. But then there's other taxes that you might add in, like additional taxes like self-employment tax and the one thing we've talked about, the excise taxes on retirement accounts, like when you take money out of a retirement account, you're not 59.5 yet. So I really should have had a line here for additional taxes.
But if you have a child, like an additional child tax credit coming back to you, that can still offset your additional taxes, though, right? If you're supposed to get a refund based on like the additional child tax credit and such, that can still offset your self-employment taxes, right?
Yes, because it's just like money in your pocket. Right? It's not like they're gonna send you a refund of $3,400 and ask you to send them a check for $1,000. They'll just send you a check for $2,400 instead.
Right. Okay.
Because this is all considered, these are all considered payments that you made, even though you technically didn't pay $934. So we have our tax minus non-refundable credits is something called net tax, plus additional taxes is our total tax, and then we add up our payments, include non-refundable credits, and we compare this number to this number to determine whether we get a refund or a balance due. And anytime you're doing someone's tax return, you should look at the software that you're using is going to produce a tax form, a 1040, and you should be able to look at that 1040 and follow its flow and make sure it's doing what you expect it to. Like if you were doing this guy's tax return, and I might do this as an exercise to give you incorrect returns to review. If this interest said $13,600 and it came up, he owes the IRS a couple $1,000s because of that, you should be able to look at the tax return and immediately say, oh, look, I must have had a typo in your interest there. I put an extra zero in there. And that is something that Eric and I spend a lot of time doing, is reviewing other tax preparers' work. And we find typos like this, or they might have wages of $33,470 instead of $740. So, but whenever we make a mistake like that, we have to call the person back. So it's better that you review it yourself and review it with the client, because you might not notice the error, but they might. If they see $13,600 in interest and they go, there's no way that I made that much in interest. Then you go, oh shoot, let's go fix that.
Yeah, because once you guys review it, if you find something wrong, they have to come back and re-sign it.
Right. Yeah, if they sign a tax return that looks like this, and we change it, every time we change the tax return, it invalidates any signatures we've already collected. Okay, pretty excited. We're going to get finally to earned income credit, which is, it's a refundable credit of up to, in 2022 is up to $6,600. Mostly for families with children, but as we'll see, some taxpayers without children can also claim the earned income credit, but it's not very generous at all.
How much is it this year?
Hmm?
How much is it this year?
6,600. It was actually 6,728 in 2022 was the maximum earned income credit. That number goes up by inflation, so I think we might be breaking 7,000 in 2023. And because this is such a large credit, and because the rules on whether you can claim a dependent are strict and a little bit confusing, we we'll again review due diligence, which we did last week on Friday, but we're going to probably repeat ourselves quite a bit when we're talking about due diligence. Okay, so we already know the difference between non-refundable and refundable credits, and now we're going to need to learn how to figure out and report earned income credit. Okay, so a quick review: a tax credit reduces your tax. A tax deduction reduces your taxable income before you figure your tax. So a $1,000 deduction might only save you $220, for example, if you're in the 22% tax bracket. But a $1,000 credit will save you $1,000. A non-refundable credit will only reduce your tax, and a refundable credit will not only reduce your tax, but if there's any left over, you'll get a refund based on that. Non-refundable credits are subtracted from your tax, but refundable credits are added to your payments. Okay, this is the first time we actually looked at, in the slide, Schedule 3. And Schedule 3 is everything but child tax credit and other dependent credit ends up on Schedule 3, and it's 2 pages. The first page is Part 1. These are all our non-refundable credits. And we'll talk about a lot of these. We won't talk about every single one. And the second page, Part 2, is for refundable credits and also other payments. There's actually a spot here where, like, if you make, oh no, they moved that to the front of the tax return. But there used to be a spot where if you file, oh, here it is. If you file an extension and you pay when you file an extension, that actually shows up here. So that would be an example of an actual payment on here. It's not really a refundable credit. Okay, so refundable credit is treated as a payment. So even if you don't have a tax liability, your income is too low to file taxes, you can still claim these credits and get a refund, even if you didn't pay any taxes. Okay. So the earned income credit, EIC for short, also sometimes called the EITC for short, is a tax credit for people who work and have earned income. And the most earned income you can have and still claim this credit is $59,187 in 2022. So, you know, I like to round these off about $60,000. You qualify for the earned income credit based on the 3 factors: your earned income, your filing status, and how many qualifying children you have. The more qualifying children you have, the higher your earned income credit can be, up to a maximum of 3 children. And your earned income credit is refundable, which means you'll get that money even if you don't pay any tax. Yeah, we'll skip that example. Okay. And
The 59 to 187, is that with 1 child or is that with 3?
that's with 3. Okay, so we're up to page 237 now. And the reason I kind of put this off until after we did child tax credit is because earned income credit is pretty complicated. There are 15 total requirements that must be met to claim earned income credit. Although some of these we've already seen before. They're divided into 3 categories. The first category is rules for everyone. The second category is rules if you have a qualifying child. And the third category is rules if you don't have a qualifying child. So, are rules for everyone. To claim the earned income credit, your adjusted gross income, so not just your earned income, but your adjusted gross income, must be less than, there's always going to be two numbers, and the second number is about 6,000 higher than the first number. So if you have 3 or more qualifying children, your income has to be less than either 53 or 59,000. If you have 2 qualifying children, your AGI has to be less than about 49,000 or 55,500. With 1 qualifying child, your adjusted gross income has to be less than about 43,500 or 49,500. And if you have no qualifying child, to claim the earned income credit, your AGI has to be under 16,480 or 22,610 if you're married, filing jointly. So as you can see right here, this big jump between 1 qualifying child and no qualifying child indicates that the earned income credit is much less generous if you don't have a qualifying child. Historically, the earned income credit was created at the same time as the Social Security and Medicare tax. And it was originally intended to basically refund people that are low income, like below this, almost poverty line, the Social Security and Medicare tax that was taken out of their paycheck. But then they redesigned it not long after to give you more of a credit with up to 2 children, and I believe we added the 3rd child possibility in 2001. Could be wrong about that exact year, but I think it was under George Bush.
And if you have more than 3 kids, you get no benefit for the 4th, 5th, 6th in this
Right.
case.
In this case, 4th, 5th, 6th children give you no further benefit. They'll still give you more child tax credit, but no more earned income credit.
But your income would still be limited by the 3 kids
Right.
model, right?
Mm-hmm. Okay. Our second rule is you must have a valid Social Security number, and it has to be valid for work in the United States, because I guess you can get a Social Security number as a non-working immigrant, like a student or something like that. And you, your spouse, and all of your qualifying children must have valid Social Security numbers by the due date of your tax return. Which means if your child was born late in the year and it wasn't a hospital birth, if it's a hospital birth, I think you get a Social Security number the same day. But if it was like a home birth or something like that, you have to actually apply for a Social Security number. And if you put that off, that almost happened to a few of our clients. If you put that off and you don't even apply until March, and this actually happened to someone in 2020, when the COVID thing started, they applied in March and they didn't get their Social Security number until after October 15th, which means, sorry, no earned income credit for you, even though your child was born in December last year.
Does earned income credit, when it looks at your earned income, does it differentiate if you had wages within 2 different countries, or does that matter? Or does it just look at what your total is?
It's based on your earned income, but if you have wages from a foreign country, that will be considered earned income. So as long as you're reporting and paying tax on it, then yes, you can claim the earned income credit based on that.
But if you're reporting and paying tax in a foreign country, they're requiring you to pay tax, or it's pulled out. It doesn't get double taxed though, right?
No, there's a foreign tax credit that you could take. There's also a foreign earned income exclusion that you can take. So if you live and work in a foreign country, and you have to live there for at least 330 days, so it can't just be part-time work. If you live and work in a foreign country, you can exclude your earned income from taxation. But as we'll see, one of the rules is that you can't do that if you want to claim earned income credit. So you have to report and pay tax on your earned income in order to claim the earned income credit. This rule about having a valid social security number by the due date of the return was created by it's called the Protecting Americans from Tax Hikes Act of 2015. Because before that, we would actually help people out, like, oh, you finally got your social security number for your kid 2 years later, they're 2 years old now, let's go back and fix your old tax return to get your earned income credit. And Congress said, well, that's lame, we shouldn't have to do those, we shouldn't have to accept those retroactive claims for these tax credits. And so they made that against the law. And remember, this is including extensions. So if you are still waiting, it's April 13th, and you're waiting for that Social Security card to show up in the mail, you're better off filing an extension, because now you have another 6 months before you need that Social Security number to claim the earned income credit. If you forget to file an extension, you'll lose the earned income credit. Okay. All right, so we'll. Oops. Okay, the third rule is, well, in the book it says you must meet certain requirements if you're separated from your spouse. And then there's, in more detail on page 238. This rule says, if your filing status is married filing separately, you probably cannot claim the earned income credit. Although there are two ways around that. Remember the rules for filing head of household, even if you're married. So head of household, so a married person, to claim head of household filing status, remember you have to live apart from your spouse, you have to live apart from your spouse for the last 6 months of the year. And you have to have qualifying person is your son or daughter. And third, you have to pay more than half the cost of keeping up the home. And so that used to be the rule for everyone who was married and didn't want to file a joint return. They added on, starting in 2021, you could let's see, you can still you still can claim the earned income credit if you are filing a separate return and you lived apart from your spouse the last 6 months of the return, or of the tax year. So they made it a lot easier for abandoned spouses to claim the earned income credit.
You ever seen people like forego their PFDs in some way or anything like that to get just under the income rules and qualify for the EIC?
It's not going to be worth it because there's a phase out, and this phase out is based on a percentage of the additional income. So if you forego your PFD, the earned income credit is not going to make up the difference. Okay. Our fourth rule, this is still for everybody. You must be a U.S. citizen or resident alien the entire year, which means, so this came up when, I don't know if you remember me telling you that people from the Marshall Islands have a free immigration compact with the United States. So you can just, if you're in the Marshall Islands, you can just show up in Hawaii and start working the next day, even though you're not a U.S. citizen. Resident alien depends on when you actually arrived. So if you arrived partway through the year, you wouldn't be a resident alien the entire year. So you wouldn't be able to claim earned income credit that first year you're in the US. And fifth, so this is what we were talking about, Dimitri, you cannot file Form 2555, which is a form that you use to exclude foreign earned income from tax. So if you want to claim earned income credit, you have to include your foreign earned income.
And effectively double tax it.
Well, you would still get a foreign tax credit. So it's not, the income is not ever going to be double taxed.
Oh, it just gets counted as part of your AGI.
Right.
Okay.
And number 6 is, this is a lot more generous than it used to be. It used to be that your investment income had to be less than like 3,000 something, but there's an investment income limitation of 10,300, which means if your investment income, which is, for most people, it's just interest, dividends, and net capital gains. I believe that also includes net positive rental income.
So what's net positive rental? I mean, like pretty much all rental income is not a loss.
Yes. So if you have like $11,000 in interest and a $5,000 loss on your rental, you don't get to count the loss because that's not a net positive rental income. But if you had $5,000 in interest and $6,000 net rental income, that would be $11,000. That would put you over the limit. So I would have to double check that. I'm not 100% about the net positive rental income, but I think that's right.
If someone sold their home and they had a gain, but they lived in it for the 2 years and such, and it would so be excluded from tax.
If it's excluded from income, it doesn't count.
Okay, so you don't have to count it in this stuff. So those times where someone make $250,000 on their home and net capital gain, it doesn't even affect their AGI or any other calculations.
Right.
Okay. It's just like.
In fact, if you don't get a 1099-S, and there's a form that you can fill out when you sell your home, that if you can check all the boxes yes, there's like 6 or 7 boxes. If you can check all those boxes yes, they will not even issue you a 1099. So if you sold your home for less than the $250,000 gain and you don't get a 1099-S, you don't even have to mention it on your tax return. You should mention it to your tax preparer so that they can be sure that they're correctly omitting your income. But you don't have to, it doesn't even go on your tax return. If you do get a 1099-S, the computers at IRS are going to see that form coming from another source, and they're going to expect to see it somewhere on your tax return. But you can note that yes, I made $140,000, but none of it was taxable, so it's going to flow through to your main tax return as 0. But that 0, that excluded capital gain from selling your home won't count as investment income because it doesn't count as income at all.
Gotcha. Thank you.
Okay, so here's an example from page 239. This person has $6,150 in wages. That's their earned income. And then they have $1,359 in taxable interest and $250 in non-taxable interest. So even the tax exempt interest counts toward this investment income limit. So, and then they have some dividends and capital gains. This is way less than the 10,300 limit. So 1,350 plus 250 is about 1,600, plus another 900 is about 2,500, and another 1,000 is about 3,500. So they're way less than the $10,000 limit.
Wait, so you said investment income, you do count the tax exempt. So that
You
basically.
do count
added
tax
back.
exempt interest, yes,
Okay, so that just gets added back in.
right. Back when this was a $3,400 or $3,500 limit, I was not a fan of this rule, but, I don't get to write the rules. I'm glad it went up to 10,000 because it could be, back when the rules was 3,500, it could be that, you know, that extra $20 that he made off of it, or extra $60 that he made in his brokerage account wiped out $6,000 worth of earned income credits for an effective tax rate of 10,000%.
So if my kid got her corporation dividends that were, say it was over 10,000 for the year, it would knock me out of the earned income credit?
No, because that's not your income, that's hers.
Gotcha. Oh, that's why we filed her taxes the other year.
Mm-hmm.
Okay, I got it now.
Okay, so, yeah, so other sources of investment income is Schedule E, which is rental income, Form 4797, which is other gains that aren't capital gains. In other words, you're selling income producing property or business related property, and Form 8814. So sometimes, well, especially when people are getting like ARC dividends and things like that, we have to be careful that we don't accidentally knock somebody out of the earned income credit by filing Form 8814. Fortunately, because the limit is so high, that doesn't happen very often, but it used to happen when the limit was 3,400.
What
Because-
was the Form 8814 again?
This is the kiddie tax. Tax on children's unearned income. And if you remember, the rule was that if your child had more than 2,300 in unearned income, then the excess above that is taxed at the parent's rate. And the 8814 is an attachment to your tax return that lets you do that without filing a whole separate extra tax return.
And that's just for the unearned income, not if they have a job.
Right. If they have earned income, they have to file their own tax return, so we won't use the 8814. So if, back in 2022, the PFD was 2,622. So it was actually 3,218, but per an IRS ruling in mid-February, 662 of it is non-taxable. So this is our taxable PFD. That means we get to subtract so since that is more than 2,300, the excess over that, $322, is actually reported on your 1040 as additional income.
So that affects your AGI?
That'll affect your AGI. It counts as investment income, even though PFD is not really an investment. And it could knock you out of this earned income credit. And especially if we have someone with like a SERI dividend, or ARC dividend of like $5,000 or $6,000, that would also be in here. And they might have like 6,322 flowing through the parent's 1040, which means 2 kids and you accidentally lost your earned income credit. So that's sometimes you have to be careful not to use an 8814 if it's going to affect someone's earned income credit.
So how do you choose not to use one?
Then we file, the child actually files the 8814. So the 8814 is attached to parents' return.
Oh, so you're at that point you simply do a full tax return for the kid.
Yep, our alternative, which is more work, but can save the taxpayer quite a bit of money, is we can instead, we can do a 1040 for the child, and we can attach this form is an 8615, which reports the parents' information from their 1040, so the child can pay the higher rate on the last $322. Fortunately, the 8615 is unlikely to be an issue in 2023 because the PFD was less than this $2,300 threshold. But it's still more than, or actually I think the 8814 threshold went up to 1400 in 2023. So that is a stroke of good luck that we just came in barely under 1400. So in 2023, I don't think we have to worry about an 8814 or an 8615 at all, except for kids who have their own brokerage accounts, something like that.
Generally speaking, kids who have their own brokerage accounts, they're probably not gonna pay tax anyway, right?
They're gonna pay tax.
If they've got a standard deduction of like, oh wait, that's right, they're limited on their standard deduction.
Mm-hmm.
Okay.
Yeah, remember a dependent standard deduction is limited based on their earned income. Okay, our seventh rule is basically where the name of the credit comes from. You cannot claim this credit unless you have earned income. And earned income is, just for sake of drilling it in, earned income is wages. Well, that includes salaries and tips, wages, etc., plus net self-employment income. And self-employment income can come from a Schedule C, a Schedule F, those are both types of sole proprietorships, or can also come from a partnership. Partners in a partnership are considered self-employed.
So if someone has a investment fund,
Mm-hmm.
it's a partnership,
Mm-hmm.
is that ordinary income,
No,
like self-employment income, or is that considered at that point investment income?
remember the K1 has it all broken down into all different. So if you have an investment partnership and all they do is invest in like stocks and bonds and get returns on those, that is going to be capital gains, losses, interest, and dividends. And those are each going to be reported on its own box in K1. So it's not going to have any ordinary business income.
Okay. So in a scenario like that, it wouldn't be considered any ordinary that you'd have to pay self-employment on.
Right, you wouldn't pay any self-employment tax on that. Because the partnership basically breaks it down and says this is your share of each different type of income. Different types of income have different flavors. There's earned income, there's interest income, there's qualified dividends, there's unearned income, and that character of income is what they call it. That character of income is preserved from the partnership level to individual level. So that's why they have all these different boxes with different codes on the K1. Okay, so here's one example. Lance only has Social Security benefits and some investment income. He's not working, so he does not get earned income credit. Another example that's not in the book, which is does happen quite frequently, is maybe someone was unemployed for the whole year and their only income is unemployment. No earned income, no earned income credit. So they may be used to getting like a $7,000 or $8,000 refund every year, But because 2023, they were unemployed the whole year, you know, they made about 70% on unemployment of what they would have working, but their refund is gonna be $0. Why? Because they get no earned income credit, and if you remember how the child tax credit works, they get no additional child tax credit either, because you have to have earned income to get the additional child tax credit also. So maybe they were counting on, because they didn't understand the tax laws, maybe they're counting on another $7,000 or $8,000 refund like they get every year, and we say, oh, sorry, no refund for you. That's because you didn't work. There is a special rule for people who get to exclude some of their income from taxation because they're in a combat zone. So your military combat pay is not taxable. And that is going to be indicated on Form W-2, Code Q. And you get a choice of whether you want to treat that as income for the earned income credit or whether you want to ignore it for the earned income credit.
Is there reasons that people would actually choose to include it?
Yes, because the earned income credit goes it increases, then it has a plateau, and then it decreases. So if you're in like this, maybe all of your combat, you're stationed there the whole year, maybe all of your pay is combat pay.
Mm-hmm.
So you would have 0 earned income without it. But if you include it, you might get some earned income credit.
Okay, so it's not a matter of you taxing it or not. It's just
No,
a
it's not
matter
taxable.
if you count it in this calculation.
Right. And not mentioned in the book, but this is an issue with at least one of our clients. There is a thing called Notice 2014-7. I'm not sure if it will come up at all in the book. But what this says is, this is called Medicare waiver payments. If you are being paid to take care of somebody by the state, that is normally considered income. But if you live with that person, you get to exclude it from income. So if you're being paid to take care of somebody that lives with you by the state, you don't have to count that as income. But there was a tax court decision at the end of 2019 called Fay versus Commissioner that says, yes, okay, you don't have to include it as income. The IRS said that. So, that they're giving you a waiver of having taxes on it. But what the tax court said was the IRS can't force you to give up your earned income credit. It doesn't change, the fact that it's non-taxable doesn't change it from earned income to something else. So under this rule from the tax court, you can also take these Medicare waiver payments that are non-taxable and count those as earned income as well for purposes of the earned income credit. However, we've done this for at least one client for the tax years 2020, 2021, and 2022. And it took until this year for them to approve those refunds for 2020 and 2021. And they still haven't approved the refund for 2022 yet. Because this is a brand new rule, this was decided by the tax court in 2019.
The fact that you don't have to pay taxes on that type of income.
Mhm.
Okay. So my mother was taking care of her like 90-year-old aunt,
Mhm.
or great aunt.
Mhm.
I don't know how her income was broken down, but it's likely that she was under some kind of welfare, disability, or Medicare, or something like that, was covering the costs of my mother's, wages at the time.
Yeah,
Would it be likely that only like a portion of her income would be subject to such tax, or the whole thing would pretty much not be subject?
it's an all or nothing. So if you're, did you say your mom?
So my mom was taking care of my dad's aunt, so
Mhm.
my great aunt.
So what this says is if you're being paid by the state under the Medicare program to take care of someone in your home, you don't have to count that as income.
So she lived in our home,
Mm-hmm.
but my mother had to work through like a caretaking agency in order to have.
That would still be excluded. So you might get a W-2, and there's actually a spot on the newest 1040s, starting in 2022, there's a spot where you can say this is excluded from income due to this rule.
So that's starting in 2019. That was the case.
No, starting in 2014. 2014 is when the IRS said you don't have to count that as income.
Oh.
In 2019, the court says even though you don't count it as income, you can still use it for earned income credit purposes.
Gosh, I'll have to check with her because I think she might have been paying taxes on that for like a decade.
So if, let's say my nephew is diagnosed with some physical or mental condition, like a disability, and he's living with me, and the state says, we're going to pay you, regular foster care payments. We're going to pay you an extra $600 a month because this kid's going to need to go to weekly therapy and have special behavioral things at the school, and you have like a lot of extra expenses due to having someone with those kind of special needs. And I'm being paid under the Medicare program for the state, but that child is living with me and they're paying me $600 a month. I don't have to pay taxes on the $7,000 a year, $7,200. But under this, I can include that $7,200 as my earned income.
So you get more of a credit back.
Yeah.
So would those payments be coming directly from the state or Medicare, or could it still be?
They're usually going through an agency.
Okay.
And there's going to be a contract between the caregiver and the agency. And it's going to say what the source of the funds were. And it's going to say the source of funds is Medicare waiver program.
Okay.
And I'm taking care of that child in my home, and because it's in my home, it's not taxable.
But if it's an elderly individual and the source of funds is like Social Security, disability, or something like that,
Then it is taxable income.
okay.
But if it came from Medicare, then it's not taxable. So we have a few, so there's one person at least who's in this specific category, but we also have several other clients who are like nurses, CNAs or something like that, and they have elderly care clients. They don't have to pay taxes on the clients that they live with, but they do have to pay taxes on the clients that they don't live with.
If somebody had multiple clients living in their home, and all those were coming through Medicare, whether they were related to them or not, they could effectively have potentially like 5 of them that just don't pay tax.
No tax, as long as you live together. So this could be you live in their home or they live in your home.
Okay.
But it does have to be an in-home, arrangement. So, for example, you might be a nurse and you live with one of your clients who, they need daily care and they need, a sponge bath, and, they need to be taken care of, and watched all night, so you live in their home, but you might have other clients outside of that home who are maybe a little bit less needy. And so you would pay tax for the clients that don't live with you, but you don't pay tax on the clients that do live with you.
Gotcha. Interesting.
Or if you were running an elder care facility, you might have one or two of your nurses that are hired to live in the home, and those nurses would not pay taxes on the income that they receive.
What if you set up your home as like a home care facility,
Mm-hmm.
and they lived in your home effectively, right?
Yeah.
But it went through a business that you set up for the home care anyway.
Mm-hmm.
Would that affect the non-taxable effect pass through to you?
Yeah. Mm-hmm. So if it was a partnership, the non-taxable effects would pass through to you. If it was a corporation or an S corporation, only your wages would end up being non-taxable.
Okay.
A lot of people actually do that in Anchorage. They set up ALFs,
Mhm.
but they're not really nice places.
What are they called? ALF?
Assisted living
yeah.
facility.
Oh, yeah.
Yeah, I mean, that's pretty good, and I mean, there's a lot of licensing hoops and inspections that you have to go through for that.
I think I've seen some people even set up like a portion of their home and then make an addition
Mhm.
for that part.
Okay, so here's an example with Linda. She's in the military, and we haven't seen much of these recently, but probably the way things are going, we'll probably start seeing these again in the next few years. But Linda was stationed overseas, and she has her regular taxable wages in the military was $2,000. How did she live on that? Well, she actually made $25,000, but $23,000 was while she was stationed in a combat zone. So it is therefore excluded from tax. But later on, when we figure out how to actually calculate the EIC, she will find out that if she only counts 2,000, she only gets an earned income credit of 689. But if she counts the whole 25,000, she'll get an earned income credit of 2,951. Also remember that military service is considered one of those temporary exceptions, temporary absence things for residency. So she might have been stationed overseas for 11 months out of the year, and her child lived in her home. Even though she was never home, that's considered a temporary absence, and so they do live together more than half the year, and she gets to claim that child as a dependent. She probably has someone else living there. Either that or the babysitting bills are horrendous. But that's an example. It could be like her unmarried live-in boyfriend or something like that.
What if it was a situation where the child stays with grandparents while she's overseas for 11 months? Could she still claim the child?
Probably not, because the child being away from home due to your military service is not that child's temporary absence. But maybe you moved your parents into your home, so maybe it's your parents are living in your house with your child. Then it would count because that's your home.
But if the child goes to the grandparents or other relatives and lives there, they're basically no longer your dependent for the year.
Right, they wouldn't be your dependent because they're not living in your home.
What if in that timeline you don't maintain a home while you're overseas?
Then if you don't have a home, then you can't have anybody living in your home.
Would you still have a head household?
No, you would end up being single and codependent. Here's another special rule, and this is, we harped on this a little bit when we talked about retirement income, but remember, long-term disability benefits basically disability pensions are considered earned income if you are underneath the minimum retirement age as defined by your employer or your pension plan. So if you are an electrical worker and you get injured, whether on the job or not, and you come down with a disability, the union will pay you a pension, and as long as you're under whatever the retirement age is for the union of electrical workers, that is considered earned income. Which means, so I did say W-2 and self-employment income. That also includes this particular 1099-R with code 3. And that will often mean if we're doing someone's tax return and they're in their 50s or 60s, we may have to do some research and figure out what the retirement age, the regular retirement age is for whoever they're working for, used to work for.
Have you had to go so far as like calling the HR office at like these companies and such?
Most of the time, we can find it just by Googling, because these are usually, large unions or civil service, like post office workers, that kind of thing.
Gotcha. Thousands of employees, it's all published.
Yeah. But yes, sometimes we have to make a phone call. Like, I think there was, we did this for a wounded police officer, and we had to call, and they said, well, we let our police officers retire at age 50, and that's pretty common that public safety employees can retire at age 50 with at least 20 years of service. And some, different employers will have different retirement ages depending on how long you work there. Like civil service is 62 with 20 years of service, or 65 with 15 years of service, or some weird formula like that. But that means technically you might not be working and you have kids and you'll still get earned income credit. Okay, so those last few rules were all about rules for everybody. And that last few slides are all about what is earned income or not. And let's see how close are we? Oh, some time left. Okay, so the next three rules, 8, 9, and 10, are going to be rules about if you have a qualifying child. Well, this term should be pretty familiar to you by now. Qualifying child, this is a slightly different context, so it has a slightly different definition, but it's based on what we learned in chapter 2. Qualifying child, that was, in chapter 2, that was called the uniform definition of a qualifying child. And these uniform rules were created in 2001. So it is slightly different. So to be a qualifying child for purposes of the earned income credit, you have to meet these 4 tests: the relationship, age, residency, and joint return test. And, well, there's one missing. That's the support test. And remember, what the support test said was that the child must not have enough income to support themselves, or they must not support themselves. So technically, and I don't see that it's ever happened yet, technically you can claim earned income credit based on a child who does support themselves. Maybe they have a trust fund or something, maybe they're Social Security. That could actually be a reason, if one of their parents died and you're the other parent, and you and all of your children are getting $20,000 in Social Security, technically the kids are probably supporting themselves because they're paying more than half of their own support, because the $20,000 is going to each of you equally. So in this case, you don't actually have to worry about that particular wrinkle. You can still claim them for earned income credit based on the relationship, age, residency, and joint return test. And these other tests are exactly the same as they were for a dependent, for the dependency qualification. Except I think they're actually almost exactly the same. There is going to be a slight change to the residency requirement. So let's see if we end up breaking these down in the next few slides. Okay, so just as a review, it's good to drill these things again, because this is one thing about earned income credit and why it's so exciting that we finally got to this chapter is because this credit is about 70% of our business in the first 2 months of the year.
What do you mean by that 70% of this?
About 70% of our clients in January and February are claiming earned income credit. And that's the main reason they come to us, is to get earned income credit and make sure they get through all the hoops to claim the correct amount of earned income credit.
Oh, as opposed to trying to do it themselves.
Mm-hmm. Okay, first one is the relationship test. I mean, I usually do them JARR, so I do joint return, age, relationship, residency, but the slides want us to do it in this order. So relationship test is, remember, this is your descendants and your sibling and their descendants. And then, like, there's extra language about stepchildren, foster children, and half siblings. So if you think of, like, this is you on your family tree, and anybody directly below you in the family tree is your descendant, and your sibling, so this is that one also counts in anybody directly below them on the family tree. So this is, I've heard the term nibbling for niece or nephew. Niece, nephew, including grandnieces, grandnephews, great-grandnieces, and so on. So anybody directly below you in the family tree or one step over and below on the family tree counts for relationship. If it was one more up, let's see, how do I draw this? So these are your parents, and then one more up would be your aunt or uncle, and then we go down from there. These are your cousins, and that is too distantly related, so those don't count. So your uncle's children, your aunt's children do not count for the relationship test. And you have to be careful when people fill out their data sheet, or if they're just talking to you in an interview. They may call this child, they may call that their nephew with quotes, because that's not legally their nephew. So if they put down nephew or niece on their data sheet, or if they talk to you and tell you that they want to claim their niece or nephew as a dependent, you have to clarify that they're actually talking about their brother or sister's children and not their cousin's children.
Just cousins' children, wouldn't that be like second cousins?
Yeah, would technically be their, yes, their first cousin once removed.
Wait, what's second cousins?
Second cousin is the great-grandchildren of your great-grandparents.
Oh, that's confusing.
Yeah. The numbers first, second, third cousin is how many steps up before you get to a common ancestor. So this is your parents, your grandparents, that's one. So your grandparents' children are your cousins. And your first cousins, if your great grandparents, great children, descendants are your second cousins, and your great great grandparents' descendants are your third cousins.
So second cousins, third cousins, they may have no clue that they're even related.
Yeah. Third cousin is such a distant relationship that you're talking about people who were alive 200 years ago. And I believe that there was a research project or a math paper or something that said that everyone on Earth is within 13th cousins of everybody else. So, or something like that.
That whole thing must be really confusing when you have big native families coming in, because you can have 4 generations in one house.
Yeah. Yeah, and
And I know my third cousin, I just call her my cousin.
And yes, everybody, especially when you have a village or a small tribe, everybody's cousin, unless they're younger than you, then they're niece or nephew. And if they're older than you, they're auntie or uncle.
Mm-hmm.
And it doesn't matter how closely related you are, they just use those words. And that's common among any culture that has close-knit extended families.
So especially with native clients, you might need to probe a little deeper in terms of the actual blood relationship.
Yeah. Yeah, my one of my best friends in Fairbanks, he was the guy who was trying to call me earlier. He's native, and his kids call me uncle, and we're not even related. I'm not even native. But we're friends, and so his kids call me uncle, and I call them niece and nephew. But for tax purposes, they have nothing to do with being niece or nephew. And that's fairly common in natives, and it's really common in ethnic Hawaiians and Samoans, and like any culture that has these close knit families. It's basically if you know them very well and they're younger than you, they're your niece or nephew.
And so at a certain point, is it do you just assume that they're a cousin just because they fit the general peer category?
Yeah, and in like native communities and other close-knit communities, you know who your great-grandparents are because you live with them. And everybody else lives with them. And you have this one household, one home that has 30 people in it, and you're all related to each other, and you know, and it's hard to keep track of who's your cousins and who's your actual nieces and nephews. And all the adults have some form of authority over the children, so they're all uncles anyway for child-rearing purposes, but not for tax purposes. Okay. Grandchild is, that includes your descendants. What this rule is, you can claim someone technically for earned income credit even if they're not your dependent. But the only way that could happen is because the reason they're not your dependent is because you signed Form 8332.
That's the one given the one parent or the non-custodial parent, the dependent, or being able to take the child tax credit from the non-custodial parent.
Yep, exactly. So remember, the 5 benefits of having a qualifying child are head of household, earned income credit, and child dependent care credit, and the child tax credit, and the additional child tax credit. And normally, in most cases, only one person gets to claim all of these benefits. But when there's an 8332 involved, these get separated and sent to the non-custodial parent. But the custodial parent still claims head of household, EIC, and child dependent care credit. Okay, so that's going to be something that is gonna take some getting used to unless you're already in this situation yourself. And I should talk about what's gonna happen when people have 50-50 custody of the kids. Because technically, if you look at the rules closely, if the child lives with each parent exactly half of the year, the child doesn't live with either parent for more than half of the year. So if you really want to get exact with the rules, if the child lives 50-50 with each of the parents, neither parent can claim the child because none of them have the child for more than half of the year. But as a practical matter, if it's 50-50 custody and the parents have, an agreement that they're following, I will just let whichever parent is supposed to be claiming the child that year claim all 5 benefits. Don't worry about the 8332 or anything. If it's really 50-50, because you can just say, there's 385 days a year, 50% is 182 and a half. So we just give the extra half a day to whichever parent is supposed to be claiming the child that year. Don't ask me about leap years, at least not yet.
Don't ask about what?
Don't ask about leap years. Okay, so when it's a 50-50 deal, we basically trust the parents to be honest about who has the 51st percent. Okay, adopted children are treated legally the same as your natural children or biological children. A foster child only counts if they are placed with you by an authorized foster agency. So if your sister just shows up at your house with her kid in tow and says, "Here, you watch my children, I'm gonna go move and live somewhere else," and you're like, "Hey, wait, well, that doesn't count because they weren't placed with you by a foster agency." Although if that actually happened, it probably wouldn't take very much time to get the OCS involved to actually make you a foster parent. But just an informal arrangement to watch your family's kids doesn't count as a foster care arrangement.
So, if that happened to someone, kids got ditched on them,
Mm-hmm.
they can reasonably probably just go to whatever state agency and
Yeah.
get it taken care of. It's not like
Yeah.
huge loops to hop through.
Not really. I mean, I've never been in that situation, so I can't really speak from experience. But so first of all, if it was your sister that ditched their kids with you, you wouldn't have to worry about it because that's your niece or nephew. But maybe it was someone more distantly related. Maybe it was your first cousin that dropped their kids off with you, and then you would, if you wanted to earn income credit, you would have to get them under foster care in your home.
Or like OCS placement.
Yeah, OCS placement. OCS is an authorized placement agency. Or a court judgment, so you could skip OCS and go to court and say, I'm going to be the children's guardians because I'm the closest relative other than the obviously incapable parent who just dropped them off at my house and was never heard from again.
So if you're a legal guardian but not technically
If you're a legal guardian, that would be a judgment or decree, so that would count.
Because I imagine if someone got a bunch of kids and they're like, all right, I'm going to have to be taking care of these for the next year or more indefinitely, then they probably want to get that legal guardian status for multiple reasons to be able to deal with paperwork and all kinds of stuff along the way.
And it would be probably a good idea, although again I can't speak from experience, but it would probably be a good idea to get OCS involved because you can get child support from that person. But only as long as you actually went through the legal hoops to do that.
Child support as in get the person who ditched the kids to pay for a part of it?
Yeah.
This OCS will pay you to take care of the kids, and then they'll bill the parents child support out of your paycheck. So if the parents aren't working and they're just being deadbeats, OCS will get funding from the state to cover the expenses, some of the expenses for the kid. Mm-hmm. And then once the parents actually go back to work, they'll start to deduct it from that.
Mm-hmm.
Oh, like they'll garnish the wages in the
Yeah.
future?
They'll garnish a percentage or something to pay it off.
Yeah, so, yeah, they'll basically front you the child support and then try to collect it from them on the back end.
Oh, interesting.
And so, like me, my kid's mom, she doesn't work, so it's $50 a month for child support. OCS doesn't pay me because it's my kid, but the state will give me, when she gets her dividend, they'll take $600 out. Or if she gets state money or, what do you get, the stimulus checks, they would take money out of that and give it to me, and then when she does eventually go to work, they'll just take her money
Gotcha.
and pay child support.
Yeah.
Interesting.
Okay. Third, we have the age test, and this is the same age test that we are used to. Child must be under 19 at the end of the year and younger than you. Or if you're married filing jointly, they only have to be younger than one of you. So that means you can claim your younger brother or younger sister as a qualifying child, but not your older brother or older sister.
Unless your wife or spouse is older than that.
Right. Yeah. So maybe you can get around that. Maybe they could be a full-time student under the age of 24. So maybe I'm 22 and I'm taking care of my college-age brother who's 23. So I get married to a 25-year-old in order to get earned income credit. It's probably a terrible reason to get married, but people have done worse.
So the 24 age for students,
Mm-hmm.
usually when someone say turns 24, say in the second half of the year, at that point their benefit is already
Yeah.
disqualified for a lot of purposes.
Yeah, under age 24 at the end of the tax year. So if their 24th birthday is anytime in 2023, for example, they won't be your dependent at all for the whole year.
So you really only get them through age 23.
Mm-hmm.
You don't get that 24th year at all.
Right.
And you don't, I guess, yeah. You get your initial half years and stuff. Okay, I'm just thinking out loud, sorry.
Yeah, so like if someone graduates age 18, so they go to college and they'll be 19 by the end of that year. So you get 19, 20, 21, and 22. Or they may start college at age 19 and they turn 20 during that year. So you get 20, 21, 22, 23. So that kind of fits in with like the typical, you know, the basic 4 years of college.
Okay.
Because some people are 19 when they graduate from high school. So that gives you that full 4 years plus a little buffer to claim your full-time students. So typically that idea is supposed to be like your traditional undergraduate students.
And if that student is working part-time through school, generally that doesn't have much of a negative effect on the parents and their taxes?
No,
These credits?
No, because all that information goes on the child's tax return. So it doesn't even show up on the parent's tax return.
But during that time that they're a student, are they usually taking their own standard deduction?
No, they shouldn't be.
Okay.
Remember the support test, even though the support test technically doesn't count for earned income credit, the support test does count for the dependency. So remember, if they are working at enough to pay for more than half of their own support, then they're probably not your dependent. And if you can't claim them as a dependent, then they won't be eligible for earned income credit either. It's just that the only time we worry about we get the exclusion from the support test is basically what we're talking about, like the kids have Social Security income of their own. And so they might technically be supporting themselves with their own Social Security income, but we don't have to worry too much about that.
So if a student, say, made $10,000 over the course of a year, with part-time work, are they able to take really any kind of standard deduction on that at all?
Remember, your standard deduction is, if you're a dependent, is your earned income plus $400.
So if they earn $10,000, they'd be able to take the $10,000 plus $400 potentially.
Mhm. Deduction, yeah.
Okay, so even if they're not claiming themselves, or even if if they're someone else's dependent, they can potentially still not pay taxes on most of their part-time earnings as a
Right.
student.
Right, so for anybody who's not from Alaska, they're not gonna be, end up being taxed at all. But because the PFD is considered unearned income, it's gonna throw a wrench in, you know, these, college age kids are going to end up paying taxes because of the PFD. And only because of the PFD.
So generally speaking, most college students are being claimed by the parents and
Mhm.
don't have generally a benefit really in trying to take that standard deduction for themselves,
Right,
because it's counterproductive.
I mean, we can do this as a quick example. If nobody else objects. But let's say we have, a student not working, or a student who is working. So we could have, let's say their only income besides their part-time work is their PFD. So for a student who's not working, they don't have a W-2, and they have, their PFD is $1,312. Or let's use 2022's rules, 2,622. Student who's not working, maybe they have $10,000 on their W-2, and their PFD is 2,622. So total income is 12,622, 2,622. And now we're going to throw in the standard deduction. So remember, your standard deduction is your earned income plus $400, but it's always at least $1,150, but never more than your regular standard deduction. So because 0 plus 400 is less than 1,150, we're going to bump this up to 1,150. And so their taxable income is, for this one, is $1,472. And for this one, our standard deduction is 10,400, because that's more than 1,150, but less than 12,950. And so this child's, or college age kid's, taxable income is $2,222. So there is a little bit of a negative effect from working, but it's only because of the PFD. And their tax is going to be, well, approximately $148. It's going to be a little bit higher because of the kiddie tax. So they're going to be a, plus whatever their tax is on 8615.
Wait, the kiddie tax applies to college students as well?
Yep.
Oh.
No, the working student, what if they work for you, then you get the rate? What is it, like $12,000 a year off as write-offs for their wages?
As long as you're counting that as income for them. But if they're 18 or older, they're no longer exempt from Social Security and Medicare tax. So you're treating them as any other employee. So it doesn't really matter whether they're working, whether you hire your kid or you hired someone else off the street.
Well,
It's
I
exactly the
was
same
referring
thing.
to like my 6-year-old working for me.
Yeah, if it was your 6-year-old working for you, then they would actually be in this category. You can pay her $10,000 for, that's probably probably excessive, but if you did hypothetically pay her $10,000 in your business, you don't have to withhold for Social Security or Medicare tax, but she's going to fall into this type of tax return, and she's going to end up paying approximately $223 in taxes, plus whatever her kiddie tax is. But in 2023, we won't have a kiddie tax issue. Let's see. In 2023, actually, let's do the 2023 rules. So in 2023, this is 1,312 for the PFD, and the standard deduction actually will have gone up to $1,200. So this kid will have $112 in taxable income, the kid who's not working, and their tax is going to be $11. For this kid who is working, it's going to be 1,312, 11,312, and their taxable income is going to be $912. And so their tax is going to be $91 in tax. Which, I mean, to me, still seems like a pretty good trade-off. You make $10,000 and your tax went up by 80. That's 0.8% tax.
Yeah. Way better having kids just work once they can work and earn, as opposed to giving them an allowance of your after-tax dollars that you pay.
Yeah, as long as that's not interfering, if they're in college, as long as it's not interfering with their studies. I mean, because you don't want your kid to get B's and C's in college and then not be able to find a job afterwards, or even get kicked out of college because they can't keep their grades up.
But I mean, you don't get it if you're supporting your student in general.
Yeah.
Beyond the tuition, you don't get a deduction of any sort for that, right?
Well, you get the $500 other dependent credit because they're a qualifying child over 17 or older. Plus, they're also a qualifying child for earned income credit. So you might get another up to $6,000, almost $7,000.
Yeah, but they're costing you like, say, $2,000 a month in housing and food.
Yeah.
Like, you're not counting that in any way specifically.
Right, you don't get a deduction for taking care of your children.
Like while they're in school.
Expenses.
And if when parents have like college expenses for their kids, if they're staying in a dorm and like housing and food is somehow maybe bundled together, are they in a way writing that off as well, or that they still have to separate that out?
Still have to separate that out. And then the support test might get a little complicated for college students if you really needed to go into figuring out whether a student was supporting themselves or not. Also remember that this 24-year-old age is for full-time students only. And full-time student means that they are enrolled full-time for any part of any 5 months of the year, which basically means a semester. So January through May, even if it was early May, January through May is 5 months. August through December is 5 months. Even if school starts on August 25th, it's any part of those months.
So I have a scenario where when I graduated, somehow I didn't get credit for like a 1 credit class. They decided not to give it to me because I had to show up or something like that on some special day. Anyway, I had to go take a whole other class at the very end just to actually graduate, like a 3 credit class, just to finish out the degree. Would that have interfered? I mean, I was probably maybe at age 24 by then anyway, but would that, if I was younger, would that have interfered with being considered full-time if I was basically full-time the rest of the year?
No, because you were full-time for any part of 5 months during the year. So if you were taking 12 credits in the spring and then 3 credits over the summer, you were still a full-time student for the spring semester, which is 5 months, January through May.
Or do they ever look at full number of credits for the whole year?
No, it's semester based. So it's whatever the institution, the college or university, whatever their rules for being full-time or not are. So in the University of Alaska system, that's 12 credits per semester. So if you took 9 credits both semesters, and maybe 9 credits over the summer, so even though you took 27 credits, which is a full-time load for most students, you were never actually a full-time student during any part of the year, because they determine 12 credits during a single semester is full-time.
So in a scenario like that, you're better off not doing the summer semester.
Well, your parents are better off for you not doing the summer semester,
Right.
because they get to claim you as a qualifying child now. But if you're not a full-time student, maybe you're taking 9 credits 3 semesters a year because you have to work and feed yourself, and your parents aren't supporting you, so you're probably better off doing it that way so that you have the time to work and keep your job.
But at that point, you don't get any special benefit for supporting yourself, right?
No, you just get to check your own box, or you get to not check the boxes when it's dependent.
You each get your standard deduction.
You get your full standard deduction, and you get your own American Opportunity Credit. There's nobody can claim as independent. And then the third age category is permanently and totally disabled. And remember, that is, you cannot engage in any substantial gainful activity because of a physical or mental condition. So that's weaker than the incapacitated or incapable standard that we were talking about for child and dependent care credit. This means you have no problem using the bathroom and cooking for yourself and taking showers and getting dressed. But because maybe you can't concentrate for more than an hour at a time, because of ADHD or some other condition, maybe that disability prevents you from actually working, then you're permanently and totally disabled. Okay. And then also remember, so there's no age limit if you're disabled, and in fact, there's no younger than you requirement here either. So if you're taking care of if you're in your 60s and you're taking care of your 70-year-old brother who's disabled, that could be your qualifying child. All right, so here's Todd. He's 19. He's not in school. He's just lazy. He's not working. He's not a qualifying child. He's 19 years old. He's too old, and he's not in school, so he misses the age requirement. Thelma's 25 and disabled. That she meets the age test. Doesn't matter what age you are. And finally, I think we'll finish up with this, the residency test. Same residency test. This is really the one that changed, but only subtly. So, what the residency test says for a dependent is the child must have lived with you for more than half of the year. The only change for earned income credit is that home that they live in has to be in the United States for more than half the year for earned income credit. So let's say you get a job, in Mexico, for 2 years. You're a construction worker, maybe you need to go build the wall or something. So you get a job over the border, or maybe you're an auto worker or something like that. You get a job over the border, you take your kids with you. You're still a U.S. citizen, your kids are still U.S. citizens. You can still claim them as dependents because they're living with you for more than half the year. But they do not qualify for earned income credit because your home is now no longer in the United States. And then you move back to the United States after that short-term contract was up. Then you can start claiming them again for earned income credit. But if your home is outside of the United States for more than half the year, you don't get the earned income credit. Let's see, temporary absences, same rules apply. And if a child is born or died during the year, then when we say half the year, we only mean half of the year, part of the year that they were survived or lived during the year, from their birth or up to their death. So if a child was born, say today, October 23rd, to the end of the year, so that's 30 days for December, 30 days for November, that's 61, and then 8 more days in October, so that's 69 days. As long as they live with you for 35 out of the 69 days, they live with you more than half the year. Which, in most cases, is easy, they just live with you. But it could be, you know, maybe you abandon your kid to the other parent partway through. Maybe you're like, 2 weeks later, it's like, I can't stand having a kid later.
Have you ever had parents be in a pickle in the terms of more than half the year, when especially if it's like parents don't live together, right?
Mm-hmm.
And things also come into play, like, you know, you got a month-long camp during the summer where the kid's not with either one of them, or
Right.
slumber parties or other stuff where, you know, things like that might interfere with the count, or do those things kind of not count?
We have, so, like we have the summer camp is considered vacation, or it could also be school, but it's a vacation. Like whether your child thinks it's a vacation or not, it's vacation for the parents. That would be considered vacation, or that would be a temporary absence, and it would be whoever the child would have lived with if they hadn't gone to summer camp, so that might be a little bit murky. If they're sleeping over at a friend's house, that's also a temporary absence. They're not really not living with you. They're still going to end up eating dinner at your place. Well, probably the other person's place, but the other parents are going to expect you to take their kid for a night too. So, but I have had some situations where it was really close. So they had a child support decree, like a child, not support, but the word's escaping me.
Custodial arrangement?
Custodial agreement. They had a custodial agreement. I'm working with the father as a client. The custodial agreement says that the child is to live with the father over the summer and every other weekend during the school year. So first of all, I say, well, based on this, the child doesn't live with you more than half the year, because that's 3 months plus, 2 out of every 7 during the school year, which is a lot less than half. But then he starts coming up with facts. He's like, well, mother left the state and left the kid with me, in violation of the agreement for these 3 months, like the whole, first semester of school. And so we ended up actually like busting out a calendar, like we're gonna highlight the days where she left the kid with you, even though she wasn't supposed to, and we're gonna add up those days, and we're gonna say, okay, that comes out to 210 days that the kid lived with you, which is more than half, and we're gonna put that in our notes, and you're also going to go and collect evidence of that, because the IRS might ask about that and might say, prove that your kid lived with you 183 days or more during the year. And just that interview itself isn't enough, because it's like self-serving testimony. But if you can get other family members, the IRS would also not really put much weight on their testimony, because they're going to be biased in your favor. But if you can get third parties to agree, like if you can go to the school and the school secretary, school principal, or the teachers and say, oh yeah, I saw dad show up and pick up the kid every week, for the whole spring, then get that on their letterhead and put that in our file, so that when if the IRS audits that return for earning and credit purposes, we're ready.
So do you need the additional proof as the tax preparer? Or
No.
really the taxpayer is the one that needs it?
Right, the taxpayer needs that, will need that just in case. So remember that we are allowed to rely on our clients' representations as long as they sound, as long as we feel like they're telling the truth.
Right.
So if they come in and we think what they're lying, we can't take it.
More so when you tell the guy, you know, go get proof, you know, you're not waiting on that for
No,
staff.
no, I'm not gonna say, oh, I'm not doing your taxes until you bring this proof back. I'm saying, I'll do your taxes, but I gotta warn you, you know, the IRS might, they might not, but the IRS might audit this, and this is the stuff you'll need. And it's easier to get it now while it was recent, instead of when the IRS audits you 2 years from now, and you're trying to get the teacher to say, oh, do you remember 3 years ago who was picking up the kid? And they're like, that's 3 years ago. I don't, it's like, who are you? I don't even know you. But when you say, oh, you remember last semester, you remember last fall when I was picking up the kid every week? And they're like, oh yeah, well, can you write that down for me? Because, you know, I need that, I'm gonna need that for my taxes. And they'll be like, yeah, no problem. But, you know, if you're doing this 4 years later, or it won't be 4 years, but if you're doing it 2 years later and the parent doesn't even remember your name, let alone the kid's name. It's much easier. So that's one thing that we do to help add value to our clients is to identify these issues ahead of time. And we're not going to put a stop to their tax return unless we really think they're lying. If we think they're lying, then as a tax preparer, it's your own pocketbook on the line, it's your own ethics. You're totally empowered to say, I'm not doing your taxes. Like, you don't, it probably, if you, would be better to push them off to a manager who has more experience, because maybe we'll notice something that you don't. But if you think they're way out of left field and it's obvious that they're lying, you don't have to give a manager's approval to just say, I'm sorry, you have to go somewhere else or do your own taxes.
So like the angry guy I had out there twice last year, I just sent him over here.
Mm-hmm.
That's good. When he shows up to do his taxes this year, I'll send him this way.
Mm-hmm. And then, and also same thing, if people are, this is completely beside the point, but if people are rude to you or angry or just unreasonable, you can be like, you can just say, you know, I'm not gonna do your taxes because of your attitude. And that one you should get a manager on your side before doing that. But we don't need our job to be any more stressful than it already is.
I remember last year, my first day of work, I had that lady come in and started yelling at me because she was 2 hours late for her appointment.
Mm-hmm.
And I was looking at Mike. First day, I was only here for 3 hours. It was just to refresh myself on the computers.
Mm-hmm.
And I thought for sure I was going to get in trouble because I snapped back. And then Mike took me on the tour, and he's like, and this is my office where I take people when I have to yell at them.
Mm-hmm. Yeah.
See, I didn't have to go that far. He showed up out there the first time. It was just a total jerk, and Sheila dealt with him. And then when he came back, he had an appointment here, and he showed up at Pittman, and he threw a huge fit. And I was like, look, man, you're not my computer. You don't have an appointment. This gentleman does, and he's coming back, and you can either wait, or you can go to Wasilla where your appointment is. And he freaked out.
I mean, yeah, we don't, I personally don't get very emotional. I have a pretty thick skin after doing this for 12 years. So I put up with a lot more bullshit myself than I would expect most people to.
I put up with a lot too, but when he got up to the counter and just put his hands down and started yelling at me, I was like, no, you need to go. I was like, I don't want you here. H&R Block does a great job. Have a good day. And that's when Sheila brought him into his taxes and didn't charge him for the prep fee and stuff. And then when he came back, he got mixed up and showed up at Pittman instead of over here. And he was super irate.
Yeah. Okay, let's see, we got joint return test coming up, but that part is mostly obvious. And then we'll save the tiebreaker rules for Wednesday. Any questions before we take a break? Before we break for the day? Okay, great. Just as a heads up, if you're going to work for us, EIC and dependency is, and a little bit of child and dependent care credit, but EIC and dependency are what you're going to be drilled on by your clients for the first 6 to 8 weeks that you work here. It's all going to be about determining the correct dependence. So this is potentially the most important chapter of the book, next to chapter 2, for at least the first 6 weeks of tax season.